Hello everyone, welcome back to our channel. Today we are diving into the latest RBI Monetary Policy Committee meeting that took place in October. For those unfamiliar, the Reserve Bank of India plays a crucial role in managing the country's economy, and the MPC is responsible for setting key interest rate. Here the repo rate is 6.5%, that is unchanged. The repo rate is the rate at which the RBI lends money to commercial banks, or repo rate makes borrowing cheaper while a higher rate makes it more expensive. Keeping it unchanged at 6.5% suggests that the RBI is aiming to balance inflation control while supporting economic growth. It indicates that they are cautious about increasing borrowing costs in a potentially uncertain economic environment. Standing deposit facility rate 6.25%. This rate is used by banks to park their excess funds with the RBI. It provides a safe investment option for banks that don't want to lend their excess cash. An unchanged rate here reflects stability in the banking system and a balanced approach by the RBI to manage liquidity without introducing volatility. Marginal standing facility rate 6.75%. This is the rate at which banks can borrow overnight funds from the RBI against their government securities, typically at a higher cost than the repo rate. Keeping this rate unchanged indicates that the RBI doesn't foresee an immediate need for banks to access emergency funds at a higher rate, suggesting that liquidity conditions are stable. Cash reserve ratio 4.5%. The CRR is the percentage of a bank total deposits that must be held in a reserve with the RBI. This helps the central bank control money supply and liquidity in the economy. An unchanged CRR means that banks continue to hold the same amount of funds in reserve, which helps maintain liquidity in the banking system without altering the overall money supply. Statutory liquidity ratio, that is 18%. The SLR is the minimum percentage of a bank's net demand and time liabilities that must be maintained in the form of liquid cash, gold, or other securities. Keeping the SLR unchanged indicates that the RBI is maintaining the current level of required liquid assets in banks, which helps ensure that banks remain solvent and can meet their obligations. The decision to keep all these rates unchanged suggests that the RBI is in a wait-and-watch mode, prioritizing economic stability and cautious growth. It reflects their assessment of current economic conditions, including inflationary pressures and growth prospects. By maintaining these rates, the RBI aims to provide certainty to the financial markets and encourage banks to continue lending without introducing additional cost to borrowers. In summary, this MPC meeting indicates that the RBI is carefully balancing the need for economic growth while remaining vigilant about inflation and overall economic stability. Important points. Repo rate unchanged. The RBI kept the repo rate steady at 6.5% for the 10th consecutive time, reflecting focus on maintaining financial stability while managing inflation. Point number 2. Shift in policy stance. RBI changed its policy stance from withdrawal of accommodation to neutral, signaling a potential future shift in monetary policy depending on inflation and economic conditions. This stance typically implies that the central bank is working to reduce the amount of money circulating in the economy. It often involves increasing interest rates to combat rising inflation, signaling a tightening of monetary policy. A neutral stance indicates a balanced approach where the central bank is not actively tightening or loosening monetary policy. It suggests that the RBI is open to adjusting rates based on economic conditions without a predetermined direction. Inflation projections. Inflation for the fiscal year 2024 to 25 is projected at 4.5%, with some variations expected during the year. The RBI remains vigilant in managing inflation within its target range of 4%. The RBI projects inflation to average 4.5% for the fiscal year 2024-25. This is important as it reflects the central bank's expectations about the future price movements. The mention of some variation suggests that while the average is expected to be 4.5%, there may be fluctuations throughout the year. The variations can be due to seasonal factors, changes in demand and supply, or external shocks like commodity price changes. Point 4. Boosting UPI adoption with measures like increasing the transaction limit for UPI Lite from rupees 2000 to rupees 5000 and raise the UPI 123 pay transaction limit to rupees 10,000. UPI Lite is a feature designed for quick, low-value transactions without needing an internet connection. It allows users to make small payments seamlessly. Raising the limit to 5,000 encourages more users to adopt UPI Lite for everyday transactions. This change makes it easier for consumers to use digital payments for slightly larger purchases without additional steps. A higher limit may attract more users who previously felt that the 2000 cap was too low for their needs. It also promotes cashless transactions, aligning with the government's push for a digital economy. UPI 123 Pay is a service that enables users without smartphones or internet access to make payments through features like IVR, that is interactive voice response, and SMS. By increasing the transaction limit to 10,000, the RBI expands the use cases for UPI 123 Pay, allowing users to make more substantial purchases using this feature. This can be particularly beneficial in rural and semi-urban areas where access to smartphones may be limited. This move aims to foster greater financial inclusion by enabling a broader segment of the population to participate in digital payments regardless of their technological resources. Point 5. RBI highlighted the concerns regarding unsecured loans, credit cards, and MFI microfinance institutions loans, urging banks and NBFCs to tighten their cyber security and account monitoring practices to prevent misuses. The RBI's concerns regarding unsecured loans, credit cards, and MFI loans highlight the need for stronger cyber security and account monitoring practices. By taking these steps, the RBI aims to protect consumers, promote responsible lending, and ensure the stability of the financial system as digital transactions continue to rise. This proactive approach is crucial for safeguarding both consumers and the broader economy. Point 6. India's current account deficit widened to 1.1% of GDP in quarter 1 financial year 25. Buoyancy in services, exports, and strong remittance receipts are expected to keep current account deficit within a sustainable level. The current account Deficit measures the difference between a country's total imports and total exports of goods, services, and transfers. A deficit occurs when imports exceed exports. A CAD of 1.1% indicates that the country is importing more than it is exporting relative to its GDP, while a widening deficit can raise concerns about external vulnerabilities. It is essential to assess it in context. While India's current account deficit has widened to 1.1% of GDP in quarter 1 financial year 25, the buoyancy in service exports and strong remittance receipts provides a buffer that helps keep the CAD within sustainable levels. This situation reflects a resilient economy capable of managing external pressures, supporting growth, and maintaining stability in the face of global economic changes. The RBI's outlook highlights the importance of ongoing monitoring and proactive measures to sustain this balance. As we continue to navigate these economic dynamics, it's important to monitor trends that could impact the CAD, including global economic conditions and trade developments. Thank you for joining me today. If you found this discussion insightful, please like, subscribe, and hit the notification bell for more updates on the economy and financial markets.